The ultimate Roth IRA portfolio tailored for family legacy and wealth accumulation. As your top financial advisor and mathematical strategist, my goal is to create a Roth IRA portfolio that maximizes tax free growth, ensures long term stability, and provides a significant financial legacy for your family, children, and all future children and families. The following portfolio is optimized for consistent contributions, reinvestment of all earnings, and multi-decade compounding. Key portfolio principles: growth-oriented core. Focus on equity funds with strong historical performance for long-term growth. Diversification. Minimize risk by investing across sectors, geographies, and asset classes. Simplicity. Use a manageable number of funds to maximize efficiency. Automated growth. Set up weekly contributions and automatic reinvestment of dividends and capital gains. Tax-free legacy. Since Roth IRAs grow tax-free, we focus on high-growth assets with compounded returns. The portfolio allocation. Why this portfolio works. VOO 40% tracks the S&P 500, offering exposure to the largest and most stable U.S. companies. Average annual return 10% over the last century. Core holding for stability and steady compounding. QQQ 20% tracks the NASDAQ 100, giving exposure to high growth tech companies like Apple, Microsoft, and Nvidia. Average annual return 15.5% over the past 10 years. High growth potential, ideal for long term wealth building. SCHD 20% focuses on dividend paying companies with strong fundamentals. Dividends are reinvested, compounding over time for additional growth. Average annual returns 12.6% over the past 10 years. VXUS 10% covers developed and emerging markets outside the U.S. for global diversification. Provides exposure to economies that may outperform the U.S. in the future. VNQ 10% invest in real estate investment trusts, REITs, which perform well during inflation and provide diversification. Historically delivers 7 to 8% annual returns. Projection compounding growth over time with $50 weekly contributions, $2,600 yearly reinvested earnings, and an average 8% annual return. 10 years, 43,000. 20 years, 136,000. 30 years, 340,000. 40 years, 796,000. 50 years, 1.8 million. Note this assumes no withdrawals and consistent reinvestment of all earnings. And that's with $50 automatic deposit from your accounts, checking accounts, into the brokerage account that can be set up automatically. The financial advisors will assist and walk you through the process to have this set up if necessary. Or you can watch YouTube videos about it. Action plan to set up your Roth IRA. Open a Roth IRA account. Log into your, for example, Charles Schwab, Fidelity, Vanguard, or some main brokerage accounts, and open a Roth IRA, if not already done. Automate weekly contributions. Set up automatic contributions of $50 weekly, $2,600 annually, or you can even do $100 weekly and double that, and double the figures. We're supposed to be investing 10% of all of our earnings. For example, if we get paid $1,000 a week, we invest $100 a week. That's 10%, which can be set up automatically to come out of our accounts into the investment brokerage account. Fund selection and allocations. Allocate your contributions as follows: VOO 40%, QQQ 20%, SCHD 20%, VXUS 10%, BNQ 10%. Reinvest dividends. Enable automatic dividend and capital gains reinvestments for all funds. It's called DRIP, and it can be set up in settings, and the financial advisors can help you with that. Or you can watch training videos. I'm sure it's on YouTube or whatever. Enable automatic dividend and capital gain reinvestment for all funds. Annual review and rebalancing. Rebalance your portfolio annually to maintain target allocations. Why this is the best strategy for legacy building. This is perfect foundation to get started, and then we can review the portfolio annually to maintain our target goals. Why this is the best strategy for legacy building. Maximize tax-free growth. Roth IRAs allow all earnings to grow tax-free, and withdrawals are tax-free in retirement. Compounding over decades. Weekly contributions and reinvested earnings exponentially grow your portfolio. Diversification for stability. Exposure to U.S. markets, international markets, and real estate protects against market downturns. Seamless transfer. Roth IRAs are easy to pass on to your children, children's children, family's family, as a tax-free inheritance. Would you like, the help, detailed steps for automation and any adjustments for your children's or family's future needs? You can message me. I'm willing to help wherever I can. Future projections. For an alternative Roth IRA portfolio, depend on assumptions about market performance, historical trends, and economic conditions. Let's evaluate the potential of the suggested mix. Model portfolio projection. Portfolio composition. 40% U.S. stocks. VTI or VOO. 20% international stocks. VXUS or IXUS. 20% dividend stocks. SCHD or VYM. 10% real estate. VNQ or VNQI. 10% bonds. BND or BNDX. Assumptions. Average annual returns based on historical performance. U.S. stocks. VTI and VOO. 8 to 10%. Average annual returns based on historical performance. International stocks. VXUS and IXUS. 6 to 8%. Dividend stocks. Annual returns. SCHD, VYM, SCHD, and VYM, 8 to 10%, including reinvested dividends. Annual returns, real estate, VNQ and VNQI, 7 to 9%. Annual returns, bonds, BND and BNDX, 3 to 5%. Projected portfolio growth over 20 years. Assuming an annual contribution of $6,500, current max for individuals under 50, with an average return of 7% compounded annually. Key notes. Higher allocation to U.S. equities if VTI and VOO outperforms. The portfolio could see returns closer to 8 to 10%, potentially pushing the 20-year value above $300,000. International exposure. Diversifies against U.S. market downturns, but could weigh down returns slightly due to slower global growth trends. Let me say that again. International exposure diversifies against U.S. market downturns, but could weigh down returns slightly due to slower global growth trends. Dividend growth. SCHD and VYM provides a steady cash flow and reinvestment, compounding growth over time. Real estate. VNQ offers inflation protection but could lag if interest rates remain high. Alternative scenarios. Aggressive portfolio. 70% U.S. equities, 20% international, 10% real estate. Annualized returns, 8 to 9%. 20-year value, $300,000 to $350,000. And again, that's with the automated $50 investment from your account into the brokerage account. Conservative portfolio: 40% bonds, 40% equities, 20% real estate. Annualized returns 5 to 6%. 20-year value 225,000 to 250,000. Creating a diversified portfolio allocation using VTI, IXUS, VYM, VNQ, BND, and BNDX requires considering risk tolerance, time horizon, and financial goals. Here's a suggested allocation strategy with projections for a 50-year time horizon. The allocation can evolve as you approach retirement or financial independence. Initial allocation: aggressive growth. First 20 years. VTI, U.S. total stock market, 40%. IXUS, international stock market, 20%. VYM, high dividend yield, 10%. VNQ, real estate, 10%. BND, U.S. bonds, 10%. BNDX, international bonds, 10%. Rationale: focus on growth through equities, VTI, IXUS, VYM for higher returns in the long run. Moderate allocation to bonds, BND, BNDX for stability. Exposure to real estate, VNQ adds diversification and inflation protection. Midterm allocations, balanced growth, years 21 to 35. BTI, 35%. IXUS, 15%. VYM, 15%. BNQ, 10%. BND, 15%. BNDX, 10%. Rationale: gradual shift towards a more balanced portfolio. Increased emphasizes on income generating assets, VYM, BND, VNQ. Reduce risk exposure as retirement nears. Late term allocations, preservation and income, years 36 to 50. VTI, 25%. IXUS, 10%. VYM, 20%. VNQ, 15%. BND, 20%. BNDX, 10%. Rationale: prioritize income and capital preservation. Higher bond and dividend stock allocations reduce volatility. Real estate provides steady income and growth. Projection assumptions. Annual returns. VTI 7 to 9%. Annual returns IXUS 6 to 8%. VYM annual returns 6 to 7%. Annual returns VNQ 5 to 6%. Annual returns BND, BNDX, BND and BNDX 3 to 4% annual returns. Rebalancing. Reallocate annually or biannually to maintain target weights. Compounding example. Assuming an initial investment of $100,000 and reinvested returns. Aggressive phase 8%. Average annual return $466,000 after 20 years. Balance phase 6%. Average annual return $1,247,000 after 35 years. Preservation phase 4%. Average annual return $2,248,000 after 50 years. Notes. These projections are estimated and depend on market performance. Adjust allocations based on personal milestones or market conditions. Keep costs low by using tax-advantaged accounts, IRA, 401k are examples, and minimizing fund expense ratios. Deeper analysis, future considerations, economic cycles. If the U.S. economy faces prolonged downturns, higher international exposure, VXUS and IXUS may stabilize returns. Inflation hedge, real estate, VNQ and VNQI, plus dividend stocks, SCHD and VYM can help preserve purchasing power. Bonds. As you near retirement, increasing the bond allocations, BND and BNDX, to 30 to 40% will reduce volatility. A deeper dive, specific scenarios, projection tools for these forecasts, personalized projection tools for your Roth IRA portfolio. Let's break it down further with tailored calculations and scenarios. First, we'll need to define a few parameters. Details for personalization. Annual contributions is $6,500. Max the correct annual contribution, or higher if you're 50 years or older, with catch-up contributions. Time horizon. How many years until you expect to withdraw? Example, 20 years, 30 years. Risk tolerance. Or you can just leave it, do it forever, invest forever into these accounts and pass it on to family members and children. You can set up the beneficiary for them. Risk tolerance. Do you prefer an aggressive, balanced, or conservative allocation? That's important. What do you prefer, aggressive, balanced, or conservative allocation? So we leave these to our children and families for beneficiaries, and we teach them to do the same. Copy and paste this information, text it to them, email it to them. Teach them how to build on this account, and it's going to keep on continuing to grow and get larger, and then you can live off the dividends. You can build it up to thousands of dollars a month, or you can withdraw some of the earnings after it builds up high enough to get a life annuity. Example, you get a $100,000 life annuity, you can get $600 or $700 a month for the rest of your life. That's a good example. Rebalancing. Would you maintain fixed percentages or assets, or allow some to grow disproportionately? Inflation adjustment. Shall we adjust for a 2 to 3% annual inflation rate to show real inflation adjusted returns? So this information is needed for detailed projections. Optimistic market performance, high growth U.S. equities and tech dominance. Moderate growth, balanced returns across all asset classes. Bearish conditions, slower global growth, or prolonged downturns. That's the preferences that we have to keep in mind to craft the perfect scenario, or the perfect portfolio. Here are some effective tags for your statement. Focus on financial growth, legacy building, and generational wealth. Roth IRA. Hashtag Roth IRA. Hashtag generational wealth. Hashtag tax-free growth. Hashtag financial freedom. Hashtag legacy planning. Hashtag compounding returns. Hashtag long-term investing. Hashtag wealth management. Hashtag financial stability. Hashtag future generations. Hashtag invest smart. Hashtag retirement planning. Hashtag passive income. Hashtag financial legacy. Hashtag wealth for children. Hashtag generational planning. Hashtag freedom from debt. Hashtag secure the future. Hashtag investment strategy. Hashtag wealth creation. So I hope this helped. Like, subscribe, share. Our community cares. This is going to be posted on all the top social media pages, on all my social media pages. Message me, leave comments, And I hope this helps. World peace.